Is it a good strategy to try to predict what the market is going to do, then make changes to your investment portfolio?
Well, the short answer is no. I think the world's most famous investor, Warren Buffett, put it best when he said the stock market is a device for transferring money from the impatient to the patient. So, for instance, if we say we've got John over here, and John feels that he's trying to predict or anticipate what the market's going to do next, and buy and sell based upon what he thinks is going to happen next. But of course he doesn't know what's going to happen next because the future's unknowable. So all he's really doing is making decisions based upon what he feels, making emotional decisions, purely emotional decisions. Or you could be like Warren, who understands that what he can see from history, because history is the only guide we have, and even if we look at, say, the S&P 500, the biggest stock market in the world, since the end of the Second World War, the S&P 500 on average has fallen 14% on average every year. Roughly every 6 years, it's fallen by about a third. But those declines have only been temporary declines, and the market has recovered, it's gone on to new highs, and it's continued the long-term advance. And the S&P 500 has returned on average about 10% per annum since the end of the Second World War. So with that knowledge, armed with that knowledge, I think it's quite clear which is the best strategy. I think Warren's doing it the right way. Through the financial planning process, when clients actually realise that if this investment is to fund their retirement, then they realise that this is actually multi-decade, even maybe multi-generational wealth, and that what they can do is take a long-term view on how this money is invested and not really have to be influenced by the media who perhaps are broadcasting that the sky is going to fall in and dramatising the latest crisis of the day. They can afford just to tune that out and just take a long-term view.